and connect with Deven Choksey, who's joining in on the show. Deven, markets perched at record highs, and in particular, there are updates with respect to some of those banks for Q1 that are coming in. Give us a sense as to how you're reading into this and what it could potentially mean for some of these names.
Good morning, Evan. Well, I think the bank in general looks, I think, interestingly placed currently, largely because of the fact that on one side, we are continuously seeing higher amount of credit growth, given the kind of thrust that the government is bringing in the business and economy, wherein larger amount of money is being spent on production linked incentive schemes in the industry per se. So, Make in India kind of a program is working, be it for defense, be it for well manufacturing, or for that matter, export-oriented products. And on the other side, the infrastructure-led expansion activity continues to do well as far as I think the business for the bank is concerned. All the companies within the ecosystem, they too basically have the larger amount of business to cater to. That is where I think some of the private sector banks, including the larger ones like SBI, among others, I think they will play a major role in expanding the loan book size. So overall, I guess I think the condition remains quite strong as far as I think the business is concerned. Maybe I think the near-term challenges are there as far as your the deposits collection in the cost connected to that. That is where probably I think some of the smaller banks are lagging behind. The larger ones still continue to have relatively higher amount of CASA ratio compared to the smaller ones, so because their challenges are many at this point of time. But overall, as we believe that in the banking space, given the kind of growth, one will have to stay with the larger units. I think larger books where the companies are having enough amount of capital to take care of the expansion in the business. So we continue to stay focused on some of the larger banks as far as I think the portfolio investment is concerned.
Right. Devin, hi, morning. What's your thought on IT?
Morning.
Nomura has come out with a note on IT. They're pretty hopeful. They're saying the top picks are Infosys, Coforge. They've got a buy on Wipro now, on HCL Technologies, TCS as well. From the earlier reduce, it's now a neutral stance. Having said that, a large part of the move seems to have already played out. We were just looking at the Nifty IT index performance year to date, month to date. It's given decent returns at a time when the fundamentals were, pretty much down and out. Would you say that this is just a tactical move? And look at it in a short-term perspective, you'll soon have the earnings as well trickle in for IT majors? Or do you see a meaningful comeback by IT?
So good morning, Ash. Well, I guess I think the important part here is that the situation per se on a business side for most of the IT companies look better than before. Most of the companies, their customers, they are running some of the larger programs, including the AI programs, which are basically being catered to for larger customer segments, be it Infosys, be it TCS, or even for that matter, mid-tier segment companies like LTIM, LTTS, or some others. So from that perspective, I think the demand outlook is expected to improve and improve for better. That is what we see. At the same time, I think many of these companies are expected to, I think, fall into the SaaS-based business model, where probably I think the revenue stream would be more predictable going forward, given the kind of strength that they have. So that is one expectation that one will have to listen from different companies' commentary. On other side, I think the market action is purely driven by the allocation of money at this point of time. IT has been lagging behind for a variety of reasons. Now, if the new money has to get allocated, which is being happening now, I would think that some of the larger companies which have been lagging behind up till now, they would be the ones who would get the benefit, and that's where the allocation of money is changing some of the IT companies. Maybe we are going to expect too big a rally in these companies, but from the bottoms, I think the companies that they end up generating 20-25% kind of return in a year's time, it would be sufficiently good return for most of the investors in IT companies as I see it.
You were just meant to get in your thoughts, Deven, on what the outlook is now for L&T, given that UBS is talking about how margins, execution, all of that is looking better. There are new orders as well. The net working capital as well likely to be lower. How are you expecting the trend to shape up for L&T?
Yeah, and I think fortunately, I think the newer contracts that the company is winning, they are won at a better price. Up till now, I think the books have been carrying the influence of the past contracts, where the rates remain quite challenging for them. Uh, Fortunately, because of the higher input cost, I think in recent times, the bidding which took place by L&T for L&T, I think has been at a reasonably at a better margin. That is what we learned. However, we think that I think it's more important to see this company from the execution point of view of next 3 to 5 years. The kind of contracts that they are winning, they are not going to get over in 1 year or 2 years. They are going to be taking I think 3 to 5 years to complete in some of the contract spaces. And that's where probably I think you're going to see the regular flow of yeah, inflow into the business as far as the revenue and profit is concerned. We continue to like this company. However, we believe that I think margin expansion, then when I think it starts materializing in the books, will probably give larger thrust. As of now, our expectation is the stock could possibly give an appreciation between 15 to 20% in a year's time at the best.
Deven, what are your thoughts on this Sebi announcement last evening about all clearing exchanges and basically asking them for uniform rates and charges for all the participants? You've been in broking such a long time, you understand exactly how Sebi thinks.
Yeah, good morning. Well, I believe that I think it's very natural for them to I think announce this particular move because otherwise, what you are probably encouraging is I think significantly large amount of volume, and that is what I think one can call it as a speculative activity into the marketplace. One of the reasons for which I think the activities have on rampant rise, I think from the derivative point of view, is also because of the fact that I think you are incentivizing the players to bring in more customers for trading. Now, should you stop this particular incentivization process, then in such situation, definitely, I think the brokers will be forced to charge the customers, which up till now, I think some of the discount brokers haven't been charging. To my mind, I think it's fundamental. When you provide any service, if you give it free of cost for longer period of time, that means that I think you are encouraging the wrong practices. You definitely need to charge one and everybody because every service does cost money. So from that perspective, I think if the move is going to aim at increasing the charges or broker charging to the customer, that will probably keep in check some part of the speculative activity. However, that is not still taking or addressing the larger particular problem that the entire industry is facing. Is about, I think, the smaller investors playing around significantly into the market for the trading side of the activity. I guess I think a lot more has to be done, including I think some ways in which I think the market lot, etc., will also have to be done away with, and including I think some of the smaller and mid-sized companies in which derivative is not there. You should make them free to enter into the market so that at least I think, and without the market lot, so that at least I think the price discovery mechanism happens I think much more stable than what currently in small and mid-cap companies are, which is currently quoting an exponentially high valuation. So yes, I think a lot of measures are required to be taken by the regulators on this particular front if they indeed want to curb the larger part of the speculative activity and encourage the investment part of the activity.
Just to understand so that our viewers get a handle of what were the how the charges would vary. Do you think, I mean, can you explain whether really large clients would get preferential rates? What would be the differential like versus average clients?
So yeah, so I think without naming any particular participant in this particular point of time, I think when you generate higher amount of volume, the exchange would end up giving you the volume-based discount and incentives, as we call them as. So in some cases, I think this particular situation is that 25 to 30% of the revenue book comes out of the exchange incentive program to some of the brokers, some particular discount brokers. Now, if these brokers end up getting this kind of discount package from the exchange, which means that I think they have the ability to not charge to their customers. And when they do not charge to their customers get encouraged to pay speculation into the market. So the practice is instituted by MII, the intermediary in the market intermediary, as we call them as, is the stock exchange, giving benefit to discount brokers. In turn, that benefit getting passed on to the customers. The customer gets into the wrong practice of doing the larger amount of speculative trade, and in turn, I think he loses money. So here, if the stock exchange is being asked not to distribute this kind of money, then probably the broker will be compelled to charge to the customer, and that in itself will keep a check on the customer from expanding his speculative activity. So that's the intent, and that's the likely impact coming onto it. So let's wait and see how exactly it is getting played out. But that's what I believe that I think will be the outcome of this particular move of state.
Okay, fair enough. Moving right on, then let's also get in perspective then from you, Deven, as to what your outlook is from some of these power financiers, the likes of REC, etc., because there is hopes hinging on this time around a scheme coming about for the sector in the budget. Would you believe that it would be an incremental fillip?
Yeah, so on one side, I think government allocation of money for the power generation and distribution, and also including the renewable segment of power generation activity and the distribution part, I think is going to be allocation is going to be on a higher side in this budget. That is what we all understand. As such, the government has spelled out their intent very clearly till 2030. They want to be spending maximum amount of money on infrastructure. In fact, their total budget between 2020 to 2030 is about 142 lakh crores of spending in infrastructure. And yearly, I think we are likely to see the budget expanding by 10% to 15%. This year in the new budget, from the interim budget, I think the infrastructure spending may be somewhere around 12 lakh crores from what they announced earlier, 11 lakh crores. So that's what I think we believe is likely to be the outcome. Now, most of the power companies and the financing companies, NBFC companies like REC, PFCs, uh, they are some of the best placed companies at this point of time. On one side, their books are clean. On the other side, they have the ability to raise higher amount of money. On the other side, I think their valuations are remaining probably, I think, even though the stock prices have rallied, their valuations are not so expensive even at this point of time. So certainly, I think you have the opportunity to earn out of this. Of course, I think the larger part of the money has been earned in last 1 year time. These companies like REC, PFC, but I still believe that I think a regular return of around 15-20% in these stocks, I think is distinctly possible given the kind of the business model and the revenue that they are currently having with the valuations.
Okay, that's the view coming in with respect to the likes of a PFC, REC.
Deven, do you track any of these liquor companies? By any chance, the market is catching a fancy beyond United Spirits as well?
I think have no understanding about this business, so regret from making any comments.
I thought so. I thought so. An important Allied Blenders management will also join us at 10:35. But today we have got two liquor companies, not only Allied, but Jagdale Industries will also join us. You may not know the name, but the prominent product you may definitely may have heard of, which is Amrut whiskey, making waves right now across the world, isn't it, Aman? That small distillery based in Karnataka. I mean, who would know that? The parent company, the Jagdale. But of course, we'll talk about all of that later in the day. I want to talk about how some of the consumer names are now coming back, the discretionary ones, even after triggers have played out. For example, Bajaj, TVS, there was a Ola Electric play out there because ICE engine companies also had incubated decent EV business, and people not giving it any value because of Ola Electric. There was a massive re-rating happening at say TVS, Hero, Bajaj. Has that played out, Devin? Could it get extended on the higher side? Look at that, TVS Motors almost 2400 now.
I think it may be a beginning of the new rally, which we are probably going to be experiencing in next 3 to 5 years in most of the two-wheelers and the four-wheeler, including passenger car companies, wherein I think the electric vehicle, along with I think the other vehicle, other engine classification, which is IC, flex, even hydrogen powered, along with electric vehicle or maybe hybrids. I think they are all likely to coexist in the universe. That is what I think we gather. The likes of Toyota and Suzuki, they are basically focusing largely on the hybrids. And they're probably trying to prove that I think on the other side, I think there is a requirement of the fuel which is going to be significantly demanded out of hydrogen. So from that particular aspect, I think you will have to be focusing on that side too, eventually for at least the larger vehicles, particularly the segment which is a cargo segment in the commercial vehicle or maybe for the railways or shipping. That's where I think the Toyotas are going to play a larger role going forward. But the two-wheeler companies in particular, like Bajaj Auto, TVS, etc., they are likely to be basically, I think, having the existence of, I think, multiple engine segments, the typical petrol segments, the LPG segments, and also the one which is electric vehicle segment. So the valuation-wise, I think the play is going to be compelling. I believe that next 3 to 5 years will be very interestingly positioned for all these companies going forward from the perspective of seeing the growth in this new category of vehicles.
Industries. Devin, now the argument coming on the street is that tariff hikes have started. First one has happened, maybe the another one will happen in the next 6 to 9 months. But in the meantime, Reliance could be prepping for an IPO of Geo business. Some of parts indicate about a third of value, 800-900 bucks. What are your thoughts on that? And are they ripe for hitting the D street now? Liquidity is abundant, business is very good right now.
Yeah, the timing can't be better than what I think currently they are enjoying. On one side, the 5G rollout has already taken place, and at the same time, I think they have also increased the tariff for the bulk consumer who are consuming the larger amount of data. So that is going to give them a significantly high amount of power, I think, to generate better revenue books. For example, I think on 1,20,000 crore revenue book, one could easily expect, I think, about 20% plus kind of a growth going forward. I would think that I think 12 months forward, I think there should be somewhere around 1,45,000, 1,50,000 crore kind of a revenue book, and on which I think about 55% kind of EBITDA margin is not ruled out because I think they are basically attacking the larger segment of the customers who are consuming more data. There probably I think you are going to see higher EBITDA margin as well. So even if today I think at around 50-55%, I believe that I think it could have the tendency to increase to a slightly higher extent. Given the fact that I think they are basically now talking about 75,000 to 80,000 crore worth of EBITDA on about 1,50,000 crore worth of revenue book in 12 months from now, I would think that it would be a perfect time for this kind of company to basically start monetizing their entire process and stay separately listed as against I think getting remaining within the fold of Reliance. So that is one important aspect which I believe. Of course, I think the Reliance has got many other verticals which are likely to probably show the similar kind of a trend. In retail too, I think the size is becoming crucial now. And with the number of brands that they have in their own portfolio, which is generating better margin, is expected to even generate a higher amount of value for the shareholders of Reliance Industries. So yes, you are right. I think there may be a price target of around 1,000 rupees for the Geo, and maybe I think similar kind of a price target for 1,100 rupees or so. I think for Reliance Retail, I think which may probably help this company to monetize the value for the shareholders, unlock the value for the shareholders.
Wanted to get
As always, for stopping by and making time for us.
If you like this video, then like, share and subscribe to ET Now.